Hello, all. Good evening and welcome. I'm Mamta Rawat from the Corporate Communications team of CareEdge. I welcome you to our discussion today on dynamic regulatory environment and MTF diversification in stockbroking. We sincerely appreciate your time in joining us for this webinar. We would like to welcome our esteemed guest speakers for today. Mr. Ankit Joshi, Senior Vice President, Corporate Finance and Treasury at Angel One Limited. Mr. Arun Chaudhary, Director and Chief Business Officer, M Stock by Mirae Asset. Mr. Jay Prakash Gupta, Founder, Dhan Moneylicious Securities Private Limited. Mr. Mohit Mehra, Vice President, Payments and Primary Markets, Zerodha Broking Limited. This session will be moderated by Mr. Sanjay Agarwal, Senior Director at CareEdge Ratings. We will commence this session with the presentation by Dr. Sudham Shingade, Associate Director at CareEdge Ratings. This will be followed by a panel discussion and a Q&A session. In case of queries, participants are requested to key in your panel. We will take up your queries at the end of the discussion. Now, may I invite Dr. Sudham to make the presentation.
Thank you, Mamta. Good evening, everyone, and thank you for joining us today. Over the last few years, the stockbroking industry has witnessed significant changes due to the evolving regulatory framework. These changes have impacted various aspects of the industry, including trading volumes, revenue streams, and the profitability. The industry's ability to adapt to these changes is crucial for maintaining stability and growth. In the light of this, today's agenda would take into account the impact of the recently introduced regulatory changes on F&O front and the mitigating steps taken by the stockbrokers, including diversification through MTF. We will also touch upon the changing revenue and the profitability profiles of stockbrokers and conclude with our comments on the credit profile of the stockbrokers. During last 6 to 9 months, we have seen key regulatory changes which were aimed at curbing excessive speculative trading in F&O segment, primarily led by the significant rise in retail participation. These regulatory changes have affected the business profiles of the stockbrokers directly and indirectly. Starting with changes announced during the budget presented in July 2024, wherein STT rates were increased substantially for both options as well as future trades. Then the regulator announced changes in MII charges, which practically has wiped out 10 to 20% of the revenue, which was coming as a rebate on transactional and turnover charges paid by the stockbrokers to MIIs such as stock exchanges. In October 2024, regulator introduced a new set of changes which directly affect the F&O trading activities. Some of the changes are already implemented, while the remaining 3 will be introduced during February to April 2025 period. Changes already introduced in November 2024 includes increased contract size of the index derivatives, rationalization of weekly index derivatives product, and increased margin on option expiry days. 2 changes are getting introduced in next 2 days, that is from 1st February 2025, which are upfront collection of the option premium and the removal of calendar spread treatment on expiry days. Last change of intraday monitoring on-off margins would be introduced in April 2025. These 6 changes, along with the increase in STT rates, have started impacting the F&O turnover. The regulatory changes have led to a sharp decline in F&O volume. Monthly F&O volume have seen significant drop from previous years, affecting overall market activity. While the F&O segment saw a nearly 46% drop in volumes in December 2024 to 6,044 trillion compared to 11,410 trillion in October 2024. Cash segment volume also experienced a slight dip in November 2024 and a rebound in volumes in December 2024. We expect cash segment volume to remain relatively stable, staying around 21 trillion per month in the near term. This slide shows the trajectory of revenue and the profitability of stockbrokers over the years. Chart on the left side shows that the revenue growth for stockbrokers remained healthy at 29% over the past 3 years, but the recent regulatory changes would result in moderation in growth to 30% for FY25. During first half of the FY25, the revenue stood at 24,000 crore, which is expected to decline to 20,500 crore in H2 of FY25. Revenue from MII charges, which have no impact on the volume, have however wiped out a good portion of the revenues from stockbrokers. Tapering of growth in PAT is also started in H2 FY25 as implementation of the regulatory changes started only from the quarter 3. We expect PAT of the stockbrokers in FY25 to remain in line with the PAT of 24 as most of the changes were introduced post October only, and bank-based broker have lower impact of FII and MII rate regulations compared to that of discount brokers. However, at an industry level, overall PAT margin is expected to decline to 31% for FY25 from 36% in FY24, despite various countermeasures taken by the industry, which we shall discuss in the next slide. In the anticipation of decline in revenue and profitability, stockbrokers have started taking steps towards maintaining stable revenue profile while protecting the margins. The key steps involved repricing of products, augmenting MTF revenues, and distribution of wealth products. Repricing involved changes such as charging for cash deliveries, which was practically zero for discount brokers. Stockbrokers have either revised the pricing or are expected to revise the same basis the trend of F&O turnover going forward in next few months. Increasing focus on distribution of wealth product and increase in MTF book remain the other key areas looked upon by the stockbrokers. Now coming to MTF, it is a form of funding provided by stockbrokers to its client for purchasing the listed shares. Investors needs to pay a fractional amount as a margin, while remaining amount is funded by the brokers. Margins provided by investors can be in the form of cash or securities, while interest rate ranges from as low as 8 to 9% to an average of 14 to 16% for these facilities. This depends on the profile of the investor as well as the stockbrokers. MTF allows investors to leverage their investment, thereby increasing their purchasing power and the potential return. MTF is expected to gain popularity, especially amidst the slowdown in F&O segment, as the investor seeks alternative leverage investment opportunities. Stockbrokers are also capitalizing on this demand by expanding their MTF offerings and promoting margin trading to their clients. As per regulatory guideline on MTF, brokers needs to maintain their indebtedness below 5x time of the net worth, and up to 50% of the net worth is allowed to be deployed in the MTF. There is also single customer exposure capped at 10% of the permissible net worth, and there are also limits on the exposure to various creeps. Now, though the stockbrokers started offering MTF product before COVID period, actual growth started picking up only in FY22. During FY24, the MTF book reached to 57,000 crore, growing at a CAGR of 70% from FY19 levels. Growth continued during the current year as well, and the AUM stood at 84,000 crore as of January 27, 2025. MTF book is expected to reach an AUM of 90,000 crore in FY25. In our view, and we believe that MTF provides an attractive diversification propositions to stockbrokers. MTF is a capital-intensive business compared to broking and allied activities, which typically has lower capital requirements. While the gearing levels of stockbrokers have increased with the growth in MTF book, they remain at comfortable level in absolute terms. Equity funding and CPs remains a key funding avenues for MTF book at present. We are of the opinion that industry level gearing will remain below 1.5x in near term, with bank-based brokers expected to continue with an average gearing of around 3.5x. Growth of MTF in FY26 remain contingent upon capital market conditions and the push strategy followed by the brokers to diversify their revenue streams. This slide shows the share of fees and commission in total revenue of stockbrokers, which has gradually declined to 63.5% in FY24 from 75.4% in FY22. This is basically the revenue derived from the pure play broking and allied activities. At the same time, there has been an increase in the share of MTF interest in total revenue from 8.1% in FY22 to 10.4% in September 2024. This increase underscores the growing importance of MTF as a revenue stream for stockbrokers. We expect that share of the MTF to grow to 12% of the revenue in H2 FY25 amidst the tightening in the F&O segment during the same period. To summarize our key findings, we believe that the revenue growth rate of broking industry would taper down to 13% in FY25 from an average annual growth of 29% recorded in the previous 3 years. In H2 FY25, the growth affected more, which led to this lower growth of 30%. While net profits in absolute terms would remain in line with FY24 levels, there will be a dip in PAT margins in FY25, mainly on account of reduction in MII charges. Again, the reduction in the PAT margin is more visible in H2 FY25. MTF book is expected to remain around 90,000 crore at the end of the current fiscal. Despite the dip in profitability and moderation in revenue, we are of the opinion that the credit profile of the stockbrokers will remain stable as industry is tightly regulated and is well capitalized. The relatively low capital requirement in broking operations allows stockbrokers the flexibility to expand their capital-intensive MTF book while maintaining comfortable gearing levels. With this, we come to an end of our presentation and we'll start with panel discussion with our industry expert. Over to you, Mamta.
Thank you, Sudham. Attendees are requested to key in their questions, which we will take up after our panel discussion. Now, may I invite Mr. Sanjay Agarwal to take over the session, please. Sanjay Agarwal is a Senior Director at CareEdge Ratings. He has over 28 years of experience in the field of ratings, banking, and infrastructure finance. Prior to joining CareEdge, Mr. Agarwal worked at ICICI Bank and IFCI. He has a bachelor's degree in commerce, a grad CWA, and a fellow member of the ICAI. He is qualified as a financial risk manager from GARP USA and as a certified financial planner from FPSB India. Over to you, Sanjay.
Good evening to all panelists and participants. A very well welcome to all of you. Thank you, Mamta, for the introduction, and thank you, Sudham, for the detailed presentation covering the evolving landscape and the significance of MTF in the stockbroking industry. We hope you found the presentation useful. We will now move on to an insightful discussion with our distinguished panelists. I'd like to thank each one of them for taking the time out of the busy schedule to be a part of this discussion. Here, I would like to highlight that all the participants and all the panelists are expressing their views and as personal views, and their views do not reflect the views of the respective organizations. So let me start with the introduction of our panel members. Our first panelist is Mr. Ankit Joshi. Ankit is a Senior Vice President in Angel One Limited, and he looks after corporate finance and treasury division. Our next panelist is Mr. Arun Chaudhary. Arun is the Director and Chief Business Officer of Mirae Asset Capital Markets Private Limited. He heads the operations and the allied divisions at Mirae. Our third panelist is Jay Prakash Gupta. Jay is the founder of Moneylicious Securities Private Limited, which is also known as Dhan. And he leads the operations and allied divisions and other functions at Dhan. And our fourth and final panelist is Mr. Mohit Mehra, who is the Vice President at Zerodha Broking, and he heads the payments and primary markets. So together we have a mix of panelists who come from established broking houses, some of the new age broking houses, the fintech broking houses, and some of the upcoming broking businesses. So we welcome all the panelists to our session. And I would like to again repeat, in case our participants wish to ask any questions, they may type in the question in the chat box, and then we'll take it up as the discussion goes ahead. Let's start with the first question for panel members. I'd like to start with you, Mr. Jay Prakash Gupta. We have seen a decline in F&O volume post implementation of new F&O regulations in November 2024. So, how do you see the trend going forward?
Yeah, hi, good afternoon, everyone. So as you rightly mentioned, there is a dip in revenue, and this dip is industry wide. And we being part of the industry, there has been a fall in our revenues as well. But I think this is too early to take a call because since the implementation of the regulatory changes which have come, markets have also started correcting, and I think in the last 4 years this has been the longest streak of market corrections. The markets have corrected almost 13% from the top. So the dip in revenue is a mix of regulatory changes as well as the market correction. So it's difficult at this moment to bifurcate how much of the dip is because of the market corrections and how much is due to regulations. And secondly, the full set of regulations is likely to pan out by this financial year. So maybe from first week of April to the quarter of April, May, and June, we'll be able to have a better clarity on what kind of impact the whole of the regulations have. So I think we will for us it's like wait and watch at this point of time. The first 3 quarters have been satisfactory for us, and we'll see the last quarter how it plays out, and then in the first quarter of the new financial year we'll be in a better position to understand what to do next.
Oh, okay. My next question is to Mohit of Zerodha. Again, Zerodha has been on the forefront of this new broking activity which has happened over the last few years. Now, what we see, despite the decline in volumes, we see a steady rise in active users. So, which segments are they actively trading in? And have you observed any pattern emerging out of the post F&O regulation in terms of shift from F&O to intraday cash or something like that?
Thanks, Sanjay. Actually, Jay mentioned, it's like fairly early. Uh, so I'll juxtapose this with an analogy. Today, a bunch of changes that might come our way in terms of regulation, they have probably impacted business in some way, but it's impossible to quantify how much. And even if you look at how they would have prompted behavior change, impossible to quantify that too. What would be a bigger impact on any given day would be how the markets are doing. And the worst form of a market scenario for any market intermediary would be a steadily declining market, which prompts people to not really do anything. So, if there's a volatile market, there are traders, people are buying, selling quickly, be it on any side, be it a quickly escalating market or a quickly falling one. But even a gradually picking up market has many takers. People want to be not missing out. They've seen returns over a period, and that we saw happen over the last couple of years. It was a gradually going up market. Uh, this one, the last few months, coupled with the regulations, if you ask me what has happened because of the regulations, what has happened because of the market um, playing out that way, impossible to really take a call.
Okay. But meanwhile, the volumes have gone down. We've seen that the number of users have increased. So, what are they targeting?
Number of users also, if you look at market penetration, that's a factor of how in the last 3 4 years getting a demat account has become fairly easy. Um, and that's on the back of digital channels of onboarding. Today you don't really have to like do a complete physical form to get started with a demat account. It's a straightforward journey, and this might sound like something one would say some 4 5 years ago, but I think we're still seeing the effects of that play out. Everybody today who might be thinking about the market if you ask them, you're thinking about the market, why don't you open an account? They have very few reasons to not open one. So opening an account is fairly easy. I mean, that absence of or reduction in correlation between active client count going up or accounts getting opened versus the actual traded volumes, that might continue for a bit.
Okay, so you are largely indicating that the impacts of digitalization or the benefits of digitalization are still playing out. So though it
Yeah,
will slightly lean
absolutely,
to it, but
absolutely. I
playing
mean,
out.
so today, you even in urban centers, if you look at people who, let's say, have been hesitant to open a demat account because they're not really sure about the markets. That's something that doesn't overnight change. It takes a few years. Somebody's heard their friends, family do well over a period of time, and then they get the motivation to open one. And it's a very personal decision playing out at these small pockets. uh, we look at the macros, all of us, but, but when you actually think about why somebody opening an account today who had access to digital channels 5 years ago also, is because it's easy for them to open it, and it's taken them some time to get accustomed to the idea that maybe outside of a bank FD they want to also be investing.
Okay, interesting. So I now move to Ankit Joshi of Angel One. So in terms of the transaction charges, what is the impact of income the broker post the rationalization of transaction charges, and what measures have been taken to, let's say, mitigate this impact till now?
Thanks, Sanjay. So, yeah, to start with, yeah, transaction charges, when SEBI announced that true to level circular will be implemented. So, impact was definitely there. And whenever any broker they design their tariff sheet, they consider various line item from where they can earn the income. And when this transaction charges was decided will be not to be charged to the, I mean, the differential between what we pay to exchange and what we collect from customers should not be charged by the broker. So brokers have decided, I mean, large section of broker, they have decided now the days of freebies are over, and brokers will start charging brokerage in cash market, which delivery segment, which was earlier free. So that's one, and then few brokers were offering first year free AMC, so they will charge. So they've started charging that also. So various levers which are available with the brokers now. I mean, few have already implemented, and if not, then in future they will have to revise it, because the earlier tariff sheet was, when it was designed, it was on the basis of certain line items of income that broker used to earn.
Okay. I'll come back to Jay again. So, given that the market volumes are expected to decrease, no, I just a minute. I'll come to Arun Chaudhary. So, the margin trading funding is closely linked to equity delivery volumes, providing traders with leverage and brokers with interest income. So, would you consider margin trading funding as a push or a pull product, and how has it impacted the dynamics of the cash market?
So, Sanjay, before I get to that answer, actually, this is something that all of us in the fraternity of the broking have been discussing day in, day out of the F&O impacts. So, I just wanted to quickly add one point where the present looks very gloomy. But if you look at the larger orientation in terms of the market, it looks like Nifty has fallen 12% over a very short period. But largely, if you look at CY24, which is Jan to December, the market still are about 9% up. And the 23% staggering return that the markets gave, I think this is just a relief that the market has seen. That's number one. Number two, we are looking at the volume fall again from a short-term perspective. So from an ADTO, which is the average daily turnover, if you look at the ADTO in the month of June, you would see that there is a big fall. But again, if you look at the longer term perspective, you look at the Jan to Jan perspective, there is only about a 12% fall in the overall volumes specifically to F&O. Third, if you really look at the clients also, we are discussing that the number of clients are increasing. We don't see much of a change in the number of clients who are entering into the derivative segments as well. So largely, if you look at the construct of the market, I would say this has happened in the market multiple times earlier. There was a regulation, say in 2021-22, where peak margin came into being. Everyone thought this is the end of the game. And then suddenly, beyond that, the market volumes have picked up like anything. So our personal internal belief is that I think the larger part of this is behind us. I don't think this what you call change in volume to be spreading for a very long period, because there's one more data point that I want to highlight. Sorry, I'm actually digressing from the question asked. But if you look at the volume, so we all know the number of expiries have been reduced on a weekly perspective, but and so are the volumes in those expiries. But if you really look at it, the non-expiry day F&O volumes have really multiplied over a period of 3-4 months. This is almost 3x. And on a Jan to Jan comparison basis, this is a 5x increase. So largely the ADTO has not changed much, which in a 12% index fall is anyways expected to change. So from that perspective, our view is a little different, saying that I think the regulation impact largely is already factored in. If at all it's going to come, it might be a 5-7% more, which might be aided, as other respectable panelists said, will be aided from the market more than the regulations independently. So that's the little on the regulations and F&O piece. Now you asked me about MTF and the impact, if I'm rightly gauging the question. See, I think I would not believe it's a push product that much, because the product volume does not increase in 2 years by 4 times if a broker is pushing a volume. So a 28,000 crore MTF book is now roughly 90,000 or 86,000, as we heard in the presentation. Our belief is that this book is going to multiply almost 3 times in the next 4-5 years. We are looking at a 3 lakh crore plus book in MTF by 2030. So, and this usually does not happen only when you keep on pushing products. Of course, there is an amount of education required from our side, from the entire fraternity side, towards educating the client on the benefits and even the risks of MTF. But I think there are multiple other reasons. Number one, this is the only product today available, approved by the exchanges, which is available where a user can actually take a delivery and hold it for a very long time, which is a leverage product. Number one. Number two, we've all seen how the options euphoria kicked in the Indian markets over the last couple of years, and it was multiplying year after year. Whereas option as a segment is very difficult to understand. Even if a newcomer comes in, understanding premiums and how the time value depreciates and things like that is difficult to understand, versus that MTF is a comparatively easy to understand product. That's number three. Number four, we've all seen now, in fact, we used to have 0 and 1 trades in what you call options on expiry days. Those 0 and 1 days have started to multiply, in fact, on all days. So what I'm trying to say is there is very heightened volatility when you participate in F&O segment, versus that, because it's a delivery replicated product which is partially funded by the brokers, the volatility in MTF is comparatively lower, because one, as I told you, you are leveraged less. Second, the holding period is far longer. So in case the trade does not go your way in a short period of time, you can always carry it on for a longer period. And lastly, I think the participation basket, for example, in an F&O, I think it's about 177 to 200 stocks that you can participate in. In MTF, you can, there are certain players who are even offering about 1,000 stocks in that. So your participation basket increases. And lastly, I think it's at very affordable rates. Although the range is big, we start from 6.99. We are lower than even home loan rates in certain cases. And it's a very, very affordable segment to participate in from the retail perspective. So all of them put together, I think where push, I would not call it a push, education-based pull product is what MTF is emerging into.
Okay. So the question to Ankit is that Arun is saying that this will become a 3 lakh crore product in a few years, and probably from a 200, 300, let's say individual names, you can go up to 1,000 names or more than that. So do you think there is enough appetite in the lending market to provide you with 3 lakh crores to the broking industry because a large part of the banking system, etc., is out of this product? So how do you think the funding, because Arun obviously can go back to a lot more investors than probably an Indian firm can. So how do you see this market, the balance liability side of the balance sheet emerging?
No, absolutely, Sanjay. Coming to the MTF product, first we need to understand how SEBI has devised this framework. So if you actually see, this framework came in 2017, and since then till date, we haven't seen any major modification or change in the framework. So at the first place only, the SEBI has come up with a very robust framework where SEBI actually decides which scripts to be funded, how much leverage a broker can take on their balance sheet. And the most important thing is there is a daily reporting of this MTF at a client level. So regulators are keeping close watch on the leverage position that customers are taking. Now, considering that the framework is so robust, product is so robust, it unfortunately the lenders, especially in PSU sector, they are still not aligned with this product. So if you see, large part of MTF book currently is funded from the debt securities market. So, in terms of source of finance, uh, uh, debt security market, CP market will contribute large portion in funding whatever growth that MTF will see. Gradually, what we are seeing that because banks are not very open for lending to MTF or lending to broker for their debit book, what we are seeing that NBFC is slowly catching up in financing this MTF book. So after CP market, NBFCs are now very aggressive in terms of funding this MTF book to the broker. So yeah, so again, it will boil down that the company who has a strong balance sheet, who has a very strong credit rating, they will be at a driver's seat in raising the capital, and they will be benefited. So the large part of funding will come from debt securities market and NBFC sector.
Okay, interesting. So we can develop this further. So I'd like to ask Jay. So this actually is a reverse question that I'm asking. It's something others should be asking me, but since you are available as a promoter of a company, so we are asking you that just now Ankit said that NBFCs will be lending, and obviously we have the CP market mainly from the let's say mutual funds, etc., funding this market. But what the question we have got from the market is that the domestic broking houses have a difficult to read sort of a balance sheet with large proprietary trades, large involvement of funds in the broking itself. So how can brokers provide comfort to other stakeholders to in terms of assessing the credit risk, and how should they go about assessing the credit risk? What is your take from the industry side of the view?
Well, Sanjay, that's a very good question. See, I like to put it this way that assessing a credit risk is rather easy at this point of time when there are so much of regulatory checks and balances in place. So what is required going forward is a process driven approach. Okay, as long as your processes are well defined, your risk policies are well defined, and you avoid doing any kind of deviations from your policies and processes, I think the risk assessment becomes easier. See, markets have become lesser volatile what it used to be 10 years back, when there was excess leverage in the market, and thanks to the regulator who have brought in right kind of regulations to control those excess leverage. Okay, that has made market kind of safe, I would say, because the kind of upper circuit and in indices or a lower circuit indices which used to see maybe during the Lehman crisis, okay, those things are things of the past now. Okay, even on the highly volatile days like election results, market did not hit the lower circuit. Okay, so if there is no excess leverage, the probability of brokers, fund, or anybody who has lent to a broker, the risk becomes somewhat lower than what it used to be earlier. I think so. The key is to have your policies and stick to that. See, the margins is going to shrink. The margins which we or the industry saw by say June of last year, those kind of margins are gradually going to shrink, and it's going to stabilize at that point, at some point of time. But if you see on a longer term picture, you see the kind of users who are getting added, okay, the number of IPOs which are coming, which is also a sign of a healthy primary market. Okay, the participations are growing. Tier 2, tier 3 users and investors, they are finding capital markets to be a place where they can they have more interest, and they have started realizing that this is a place where wealth can be created, rather than only being into the traditional asset classes like gold and property. So I don't think the investor base is going to fall, because the interest is growing over a period of time. So you will have a larger pie to cater to, and if you are more process driven, I think you will have a larger pie going forward.
Okay. Now I'll read you exactly what the market participant told us. So the numbers look fine on balance sheet, but related party transaction, hand in various stocks, prop trading are difficult areas to judge when you are carrying out the assessment of the balance sheet. So how would you like to advise the broker, or would you like to advise the market participants? Which side of this coin would you like to take care of?
So it's important that if you see, we don't run a proprietary book, okay, but for whoever who is running, it's important that you need to have a Chinese wall between your funds, your positions, and what you are doing on the client side. I think there are great players on the proprietary desk or proprietary side of the business as well. They're much experienced, have seen a lot of volatilities, and have a lot of access to capital. But I think the only thing which is required is a discipline and prudence, and the kind of regulatory frameworks which are available now. I think it's by design that you have to be compliant. And so I feel that it's the days are gone where we had seen in 2015 to 18, where a lot of non-compliances happened. A lot of entities misused clients' money, and I think those the regulations are the fallout of those events. I think we're in a much better and safer environment as of now. So so whatsoever environment you have, the prudence also has to come from within. So it's also up to the organizations and their promoters to design the policies and do the business the way it is to be done.
Yeah, I agree with you. So internally also we see the things in a similar manner. So whatever is transparent in the balance sheet and can be understood, we rather go by that rather than trying to get behind the figures and try to get good out of something which may or may not be there.
Correct. Yeah.
So that's how the market is. So actually Arun has raised a hornet's nest by saying 3 lakh crores. Now people are asking that, do we expect huge equity infusion, or will that be funded by the gearing?
So are you asking me, Sanjay, or is it for Arun?
Arun, I'm asking Arun. So because he said 3 lakh crores,
so it can be either. So I won't be in an absolute position to answer that, but I'm talking about the exuberance that the markets are showing. So in fact, from a client participation perspective, even in the cash segment, which is where we saw a fall in the ADTO, which is what I also spoke about from Jan to December, that's picked up again. So what I'm saying is that the participation in the delivery segment is also giving many opportunities to investors to be staying invested in the right kind of stocks. In our case, primarily it's the equity part that comes in, but then it'll have to be an industry specific answer.
okay. So my next question is to Mohit. So given the current market environment, we're seeing a lot of increase in the trading activity, commodity, currency, etc. So do you think that will match up to the equity trading, or will equity trading remain the mainstay?
Not following commodity closely, but currency has, after last year's circular that RBI had issued, really fallen So activity in the currency segment is not really there.
Okay.
So last year, just to give context, RBI wanted anybody who had a provable exposure to currency risk to be trading uh, any currency which was traded in an INR pair. Uh, and post that, like the currency segment across the board, volumes fell very drastically that month itself. So if you ask me if regulatory action can have like a bearing on trade volumes, it can. And if you look at the currency market charts, there you will see it. But the current regulatory changes that happened, it'll take some time to like really know for sure because of them how behavior and therein the volumes have changed. The currency one was like very you can like look at the chart, see a waterfall happen there. So like
Okay. And do we see that the broking income would move more towards the wealth and advisory side of business compared to the pure play, let's say, platform transaction that they are doing right now?
very different segments. So a retail brokerage that's providing a platform, if it's catering to somebody only wanting an execution platform, even if you offer them services outside of that, will they be takers is the bigger question. Now, there will be a certain part of that segment that you're servicing, maybe somebody with a lot of wealth who would want it. But the next question comes at what cost? Would these people who've been till date do it yourself investors, even at a HNI bucket, would they be wanting to shell out some fee for advisory? Some of these people would, some of these people wouldn't. But I wouldn't peg a number to it if that's going to be bigger than just execution.
And I'd like to ask this question to Jay that from November onwards, SEBI had restricted weekly expiries to just one per exchange and all other for the main indices, and for other indices it was one per month and all that. But then in January they allowed the MSCI to introduce weekly expiry. So is this a contradictory thing which is happening, or it's in line with that the way SEBI has been moving around in regulating F&O?
Sanjay, I haven't, just to be very candid, I haven't gone through the, the whole scheme of things about MSCI. So at this moment, I won't be in a position to give my views there. Yeah.
And coming back to MTF, this question from Ankit, who had the treasury in Angel One. So, what are the typical questions you get while discussing financing proposal with debt investors?
Right. So Sanjay, as Jay mentioned, the first and most important part when any bank or any credit institution they assess for the limits, they would see what kind of risk management policy, risk management systems we have, and under various scenario, how risk management system is responding, because that's the most important thing any financial institution before lending would like to see. Then apart from that, they would like to understand the kind of business model the broker has. Then they would also like to see what is the size and size of the balance sheet, what is a leverage ratio of the company. So basically, they will check the fundamental ratios. They will also see how strong the management is and how they are responding, because broking is very dynamic industry. In last 3 to 4 years, we have seen so many regulatory changes, and so you really require that kind of very agile management to align to all those changes. And so these are basically typical points that any banks or any financial institution would like to see.
So it comes back to what Jay is saying, that people would like to see through whatever they can see and understand that and get comfort from whatever is there, rather than trying to understand what is inside, what is behind, and get more comfort from other figures or anything.
That ultimately it boils down to how well you are managing your risk. Because if you are funding any particular position, you are not very aggressive in funding that position, and you are not taking that risk. You are not taking that risk on your balance sheet. So risk management is very, very crucial when it comes to lend for MTF.
Okay. So I have one question other than Ankit, which is a listed company. So I'd ask the others. So how do you see the industry for the next 12 months in terms of the volumes, the income, then the profits? So I will start with, let's say, Arun first. So how do you see the industry for the next 12 months in terms of volumes, revenues, and profits?
So I personally believe that the volumes, the FNO regulation impact should be behind us in maximum next 30-35 days. It should not last for more than a month or two. We've already seen that shift happening in January versus December. Of course, the only thing that can further destabilize the market is any other global event that might impact us. Other than that, largely, I don't see anything specifically changing. Now, from the revenue and profitability perspective, I can comment on our own stature in that case. I think personally, so that's I think where I stand a little different versus other panelists. We've not seen a fall in our revenues over the last 2-3 years, or 2-3 months, and so is profitability. And I feel that with our large dominance in terms of MTF, which has been our flagship since the day we launched, I think, and a diversified pool of income now coming in via the brokerage income as well. I think the revenues, we should see a considerable increase in our revenue in the next 12 months, and so will be the profitability.
Okay. So Mohit, same question with only one request, that I request you to focus more on the industry as a whole than your particular business house. So because that is how I'd like to have the audience get the value of your, let's say, discussion.
I'll split this into two parts. I'll start with an opinion, and then I'll explain the rationale. So the opinion that I have is probably there is some hurt to be seen in the revenue profitability side industry-wide. Rationale I'll get to. So the peak volumes that we saw were around June last year. Now that was on the back of a bunch of things. There was volatility globally. There were the exchange, the election result days happening, a bunch of volatility leading up to it, around it. And then right after, you saw a massive drop in volumes the next month itself. July was about more than 20% lower than June, the peak. This is the derivative trading volume. I'm not looking at the notional numbers. They're difficult to compare. I'm looking at the premium turnover coupled with the futures turnover. And if you ask me today, if we can get back to similar activity, that happens if maybe there's similar exuberance. That happens if the markets suddenly start doing really well or start doing really badly. That sudden exuberance, if it happens and sticks around the same way it did after COVID, with the markets rallying with each quarter, with each time period, a replication of that is a possibility where we go back to similar numbers, maybe do better even. But unless that scenario plays out, I don't see how trade volumes will go up in the short term, which is a year or so. The brokerages could be changing pricing structures to make up for things, but underlying volumes itself, I doubt.
And how do you see the revenues and profits? Then will it follow the same route, or they can get diversified?
It depends on the pricing decisions, a bunch of things you do across products. For some brokerages, it might work out. For some, it might not. But that's more like speculation, which I'm not sure if I have complete unhesitant view on. But if you just ask me about the trade volumes, I would say maybe we're not going to like hit June peaks like very quickly. Hopefully, I'm wrong.
So Mohit does not want to take the responsibility for the trade tomorrow. So no views on the industry as a. So Jay, before this question, another question to you that I think we should have done it ourselves. People asking what is the difference between LAS and MTF? A very basic primer question. So
See, MTF is something which a broker can do from his own funds. Okay, for a loan against securities, you are lending against certain kind of security. So the primary difference is the for somebody, they can use the money if they want to avail a loan against shares. The money can be used for different purposes. But for MTF, it's primarily for the purpose of again buying some kind of stocks. Okay, so it's investing within the capital market ecosystem itself, or for having a trade in the secondary market. For LAS, the usage can be multiple, not necessarily that it has to be invested in shares.
So the LAS is done by NBFCs or banks, and MTF is done by brokers.
Yes.
So and both parties cannot do the other transaction. So brokers cannot do LAS, and obviously MTF cannot be done by others.
Yeah.
Okay. And now we have our question on how do you see the volumes, the revenues, and the profits for brokers?
See, industry-wide, if I would say, last couple of years have been a very euphoric times because of the surge in F&O participation by retail users. Okay, so now since the regulation is changing that momentum, I think the impact will be overall industry-wide. How the impact is going to play out in 12 months time, that I said earlier in the webinar, that we will be able to take a call on that in the coming financial year. But overall, if you see industry wise, there is a lot of participation, lot of newcomers who want to be part of the capital market ecosystem. So that's a very encouraging thing for the industry. So industry will figure out its way, since I don't see that this industry is going to go in a bearish downturn phase, because financial markets and capital markets has been there for a while now. It's a century old industry, and with time, there are models which keep on changing. The model pre-COVID was different, during COVID was different, and now with the new set of regulations, the industry will evolve itself. And the industry, the prospect is bright, because as long as the citizens of the country start feeling that okay, capital market is the place to be. I think we are witnessing that. If you see the kind of dip we are seeing in the savings bank account, the kind of IPOs we are seeing, across industries, across sectors, there are companies who want to be getting listed. The kind of new demat accounts getting opened. Okay, these are all encouraging signs, and with going forward, the difference between being a fintech and being a broker is the line is getting shrinked. Okay, so you have to offer more products, more instruments to a user, because a user, not necessarily the new user who would come in the market, would not necessarily come only to trade or only to invest in an IPO, but they would require a bouquet of financial services available to them. I think so. There are good times ahead, I feel. So this is just one of the points or one of the phases where हर कोई say in humans life, you fall sick for some time, but that does not mean your life ends there. You recover and you come stronger out of it.
Right. So how do you see the equity invest? I mean, I'm seeing the investors into the broking companies. So how do you see that equity appetite in the market? Means now obviously the amounts being required seem to be going up very substantially, because the products somewhat are capital intensive. So how do you see the equity interest? Is there sufficient interest, or the industry will have to gradually build itself? How will you see that?
Yeah, I think, that's what I said, that the industry has to evolve itself. See, if you see in any economy, right, the sector or the industry grows, you require the help from the financial institutions. Okay, be it manufacturing, you name any sector, where the banks play a pivotal role in the growth of any sector. So if in terms of capital market in terms of capital markets also, there has to be more doors or more participation from the banks and financial institution, which is required. So currently, if you see, MTF is a product which the lending, the banks are not comfortable with, but maybe that scenario would change if, with right kind of policies and right kind of risk measures, you may find that the banks would be interested to fund a broker for the MTF book. Going forward as well, if you have working capital requirements, okay, the banks and the financial institutions are able to provide the lending at a competitive rate, that will give a boost to the overall industry as such.
Yeah, thanks for that. So we have two questions which have been coming again and again, and I would not like to ask them. So one is that how hard is it for the broker to deal with regulators, and what expectations you have from the budget? So I would just keep it as a question and not answer them. And so I thank all of you. We come to almost 1 hour now, so we come to end of the session. Well, there are some more questions, but we'll probably take them one on one. So I'd like to hand the proceeding back to Mamta for the closing comments.
Thank you, Sanjay, for moderating the session, and Sudham for your presentation. Once again, thanking all our guest speakers for their insightful views. It was a privilege to host you. And lastly, thank you to all the participants for taking the time out and being a part of this CareEdge webinar. For any further queries, feedback, or suggestions, please write to us in the feedback mail. Goodbye for now. Requesting the tech team to kindly log off.